The capital asset pricing model, better known as CAPM, is a widely used model in finance that helps to determine the expected return on an investment, given the risk-free rate, the expected market return, and the asset's beta. The risk-free rate is the return on an investment with zero risk, such as a government bond. The expected market return is the expected return on the overall market. Beta measures the volatility of an investment in relation to the market as a whole. A beta of 1 indicates that the investment's price will move with the market, while a beta less than 1 means it is less volatile than the market, and a beta greater than 1 indicates higher volatility. The CAPM formula works like this. The expected return on an investment is equal to the risk-free rate plus beta, multiplied by the market risk premium, where the market risk premium is the difference between the expected market return and the risk-free rate. So, the expected return on an investment equals the risk-free rate plus a premium, which is determined by the beta and the difference between the expected market return and the risk-free rate. An important assumption of CAPM is that investors are rational and risk-averse, and that they have access to all available information. Also, it's assumed that markets are efficient and there are no transaction costs or taxes. CAPM can be used by investors to evaluate the potential return on an investment, as well as by companies to estimate the required rate of return for a project or investment. However, it's important to note that CAPM has its limitations, such as the assumption of a normal distribution of returns, which may not always be the case in reality. Also, it may not work well in markets that are not efficient, like emerging markets. Overall, the capital asset pricing model is a widely used model to determine the expected return on an investment, given the risk-free rate, the expected market return, and the asset's beta. However, it's important to understand its assumptions and limitations to properly interpret its results. Thanks for watching another episode of Finance in 2 Minutes. We love making finance easy, and if you love learning with us, hit that subscribe button and join the crew of money-savvy investors. Oh, and don't forget, you can grab your free summary cheat sheet by clicking the link in the description. See you in the next video!